Welcome to Money Moves, where today we're diving into the timeless wisdom of Jesse Livermore, one of the most famous traders in the stock market's history. Livermore's 21 Rules for Investors offer a masterclass in market psychology, strategy, and discipline. So who was Jesse Livermore? Jesse Livermore, often dubbed the Boy Plunger and the Great Bear of Wall Street, lived a life that read more like a high-stakes drama than a financier's biography. Born in 1877, Livermore's journey from farm boy to financial legend is a tale of grit, wit, and an uncanny ability to ride the seismic waves of the stock market with unparalleled agility. Livermore's tryst with the market began at the tender age of 14 when he fled home with dreams bigger than his pockets and a mind sharper than the seasoned traders of his time. Working his way from chalk boy to one of the most feared and revered figures in Wall Street history, Livermore's knack for speculation was nothing short of a finely tuned instrument playing in the complex orchestra of the early 20th century stock market. He made millions, which in today's terms would be equivalent to billions. During the stock market crashes of 1907 and 1929, demonstrating an uncanny ability to predict market trends. His achievements were legendary. With a career punctuated by spectacular wins and dramatic losses, he made and lost fortunes with the ease of a gambler, but behind what seemed like bets lay a profound understanding of market psychology and an unerring ability to predict market movements. Now you have a brief idea about Jesse Livermore. Let's delve into his timeless rules, which remain a gold standard for traders seeking to decode the market's mysterious ebb and flow as much in 21st century as they were 100 years ago. In essence, Livermore's 21 rules are a roadmap to successful trading. They're not about getting rich quick or predicting the next big thing. Instead, they underscore the importance of patience, discipline, and a rigorous understanding of market trends and behaviors. Livermore's wisdom is timeless, not because it guarantees success, but because it provides a framework for navigating the unpredictable seas of the stock market. It's about making informed decisions, managing risk, and most importantly, learning from our mistakes. Rule number 1, history repeats itself in the market. Jesse Livermore believed that the market is cyclical, and its patterns tend to repeat over time. By studying these historical patterns, investors can better anticipate future movements, providing them with an edge. Moving on to rule number 2, patience over constant action. Livermore cautioned against the allure of constant trading. He believed that successful investing requires patience and discernment, rather than the frantic buying and selling often associated with the stock market. Rule number 3, market confirmation is key. Livermore advised waiting for market action to confirm your opinions before fully committing your capital. This ensures that your decisions are based not merely on personal bias, but on the actual direction of the market. On to rule number 4, trust the market, not opinions. The market reflects the collective actions and sentiments of all its participants. As such, it's a far more reliable indicator than personal opinions, which can often lead us astray. Rule number 5, profitable positions show early promise. According to Livermore, the best investments are those that start showing profits soon after you commit to them. This indicates that the market supports your decision, affirming your choice. Next, rule number 6, patience with winning stocks. If your investment is performing well and the market conditions remain favorable, Livermore suggests resisting the urge to sell too soon. Let your profits run and grow. Rule number 7, speculation versus investment. It's crucial to distinguish between speculative ventures and long-term investments. A speculative bet should never turn into an unplanned long-term holding. Understanding the difference and acting accordingly can save you from potential pitfalls. We continue with rule number 8, the high cost of holding losing investments. Livermore keenly observed that many investors, driven by misplaced optimism or fear of admitting a mistake, cling to losing investments in the hope of a turnaround. But more often than not, this strategy leads to bigger losses. It's crucial to cut your losses quickly and move on to better opportunities. Next, we have rule number 9. Price declines don't guarantee bargains. Just because a stock has fallen from its previous high doesn't necessarily make it a bargain. The decline could be entirely justified due to changes in the company's fundamentals or the broader market. Always do your homework before jumping in. Rule number 10 is an important counterpoint. High prices don't necessarily signal a sell. Just as a falling price doesn't automatically make a stock a bargain, A rising price doesn't necessarily mean it's time to sell. If the company's fundamentals and the market conditions remain strong, there might be more room for growth. Moving on to rule number 11, buying at new highs. Livermore was a proponent of buying stocks breaking out to new highs, viewing them as having passed a test of strength. A new high signals market confidence in a company, which can often lead to further gains. Rule number 12 is a hard pill to swallow for many. Never average down. While it might be tempting to buy more of a losing stock to lower your average cost, Livermore advised against it. This strategy often leads to larger losses if the stock continues to fall. Then we have rule number 13, emotional discipline. The psychological aspect of trading can often be an investor's downfall. It's important to keep your emotions in check, sticking to your investment strategy even when the market gets tough. And rule number 14, eliminate wishful thinking. Investing decisions should be based on hard data and thorough analysis, not hopes or wishes. Remember, the market has no room for sentimentality. We're almost done. Let's continue to the remaining rules. We're now at rule number 15, significant moves take time. Livermore knew that big market movements don't happen overnight. Patience isn't just a virtue in life, it's the bedrock of successful investing. The most substantial market movements unfold over months or even years, not days or weeks. This long-term perspective allows investors to capitalize on the true potential of compounding gains and to remain unfazed by short-term volatility. Rule 16 warns that overanalyzing can be counterproductive. While understanding market movements is key, getting stuck in every price fluctuation can be counterproductive. In a world awash with data, the temptation to dissect every market move can be overwhelming. However, this hyper-focus on minutiae can lead to analysis paralysis, where decision-making stalls under the weight of excessive information. While being informed is crucial, it's equally important to filter out noise and focus on the signals that align with your investment thesis. Balancing due diligence with decisive action can prevent missed opportunities and regret. Rule 17 emphasizes that focus is crucial. In investing, as in life, spreading oneself too thin can dilute effectiveness and outcomes. Concentrating your attention on a select few stocks or sectors enables a deeper understanding of their potential and risks. This focused approach allows investors to become specialists rather than generalists, making it easier to spot opportunities for growth or identify warning signs of trouble ahead. Livermore's 18th rule states that the leaders of any market or sector often serve as bellwethers for broader trends. If an investor struggles to achieve gains with these frontrunners, it might reflect broader challenges with their market strategy or understanding. Focusing on leading stocks can provide a more reliable pathway to success, benefiting from their momentum and stability compared to more speculative options. Rule 19 warns that leaders change over time. Today's market leaders might not hold their crown tomorrow. Industries evolve and companies fall in and out of favor. This fluidity requires investors to stay informed and adaptable, ready to pivot their strategies as market dynamics shift. Keeping an eye on emerging trends and sectors can uncover the next generation of leaders before they ascend to the top. Rule 20 advises traders to avoid market extremes based on a single stock. One anomaly should not dictate a broad market strategy. If a single stock defies the general market trend, it's an exception, not a rule. Wise investors assess each investment on its own merits, cautious of extrapolating broader market sentiments from isolated incidents. This discernment helps maintain a balanced portfolio, insulated from the volatility of singular stocks. Lastly, Rule 21. Be skeptical of tips. In an era where information is abundant, distinguishing between insight and noise is crucial. Livermore's caution against relying on tips underscores the value of independent research and decision-making in investing. While tips can provide initial pointers, thorough analysis and personal conviction should drive investment choices. This skepticism towards easy gains protects investors from the pitfalls of herd mentality and misinformation. Jesse Livermore's rules remind us that at the heart of successful investing lies a blend of discipline, patience, and a keen understanding of market dynamics. By applying these timeless principles, investors can navigate the complexities of the market with greater confidence and potential for success. Thank you for joining us on Money Moves. If you're inspired to apply Livermore's rules to your investing strategy, don't forget to like, share, and subscribe for more insights. Until next time, keep making those informed and strategic money moves. Disclaimer: we are not licensed financial advisors. These videos are intended for educational purposes only. No official financial advice is being given. Please always check with a licensed professional before making any investments or financial decisions. Your investments are your sole responsibility, and in these videos, we merely share our own opinions with no guarantee of gain or losses.